The RBA interest rate pause continues into spring, and economic data suggests more of the same ahead, but still a risk of one more hike. An update of our market forecasts and the key indicators to monitor in September. The third RBA pause at 4.1% rounded out Philip Lowe's 7-year term as governor, and he passes the baton to Michelle Bullock with an economy that is still growing in real terms, albeit at a decelerating pace, and with unemployment still near 50-year lows, but the best of labour markets clearly behind us. The last 7 years have been characterised by very supportive monetary policy, especially through the pandemic, until the 2022 inflation shock, when RBA rates were increased by 4% in 15 months, the fastest pace of hikes since 1985, but still a more moderate profile than comparable economies. Fortunately, the impact of tighter policy is playing out as hoped thus far, with retail sales and household spending now falling in real terms, GDP and jobs growth slowing, and demand for credit easing. This slowdown on the demand side is helping to achieve a better balance with damaged supply chains, which are steadily improving and, in our region, appearing more sustainable. Headline CPI is down to 4.9% based on the monthly series, and as the chart shows, core indicators are also improving, but we've got a long way to go to get back to the 2 to 3% core inflation target. Recent wages data has been more benign than feared, but this will be challenged in the third quarter. Recent increases in house prices, rents, and higher energy costs complicate the outlook. So in September, the main data to monitor will be the next job numbers out on the 14th, monthly CPI on the 27th, and retail trade on the 28th, none of which is expected to give Michelle Bullock any reason to tighten rates in October, but will all be relevant for November after the next quarterly inflation report. We continue to suggest that this tightening cycle will last longer than consensus forecasts, and that rate cuts are less imminent than many have predicted. More recently, the yield curve has adjusted to more closely match our view, although the timing of the next RBA hike, if we are to get one, remains the most uncertain factor. One more complication to the outlook continues to come from China, where their PMI surveys, where below 50 is contractionary and above 50 is expansionary, shows a slightly rosier picture than feared, but very much at the mercy of further policy support. Troubled Chinese property developer Country Garden has extended some of its debt repayments, but will remain in focus, together with the market's hunger for wider, more effective stimulus measures. In summary, the domestic economy and global markets are responding to the impact of sharply higher interest rates, and so far are absorbing the shock resiliently. But the consensus view of no more RBA rate hikes, a soft landing, and imminent cuts appears naively optimistic. A less ambitious view of one more hike with a longer tightening cycle, the risk of a technical recession, but nevertheless economic outperformance for Australia appears a more realistic outlook. And that's the market update from Bendigo Bank.